Welcome to the Ellsworth Advisors monthly update for February 2022. I'm Kelly Keenan, this is Cameron Mealy, and today we are going to review what's been happening in the markets, the economy, a few world events, and then discuss how our portfolios performed year to date and for the month of February, and give some thoughts on what we see coming down the pipe the next couple months or so. Cameron, why don't you kick it off with some economic information?
Thank you, Kelly. Good morning, everybody. If we look back over the previous month, last month there were really two issues we were talking about. Number one, inflation. Number two, potential military crisis in Europe. Unfortunately, now we've seen Russian forces have invaded Ukraine. It is a terrible humanitarian crisis. It's hard to believe that in 2022 we're talking about a land war in Europe. That situation has obviously created a lot of headline risk. It's created a lot of the volatility. But really the biggest underlying issue for the United States economy right now is inflation. The Ukrainian crisis has only added to it. Russia is one of the world's largest producers of oil and natural gas. They've been virtually cut off from the world market. Russia is also a huge agrarian society, and in particular their wheat supply is a big export for Russia. That's been virtually cut off. So we're seeing more scarcity in energy. We're seeing more scarcity in food supply. And that's just, continuing to make inflation, as I said, the number one risk for the U.S. economy. Let's look back at inflation. This is according to the Personal Consumption Expenditure Price Index, and this is by the Bureau of Economic Analysis. This is the Fed's kind of gold standard in the way they measure inflation. If you look at the year-over-year increase in inflation, starting in October of 2021, it was 5.1% year-over-year increase. November, 5.6. December, 5.8. January, 6.1. Now, this morning, in large part due to the Ukrainian crisis, the Wall Street Journal and their forecast of leading U.S. economists is projecting that in February, we're going to see a 7.8% increase in year-over-year inflation. We've said this several times, but that is a new 40-year high in year-over-year measurement. So inflation is obviously a significant issue. It's a disruption to business. Unfortunately, it really hurts middle and lower class individuals as it really cuts into their spending power. How are we going to address inflation? So on March 2nd, in testimony to Congress, Fed Chairman Jerome Powell stated that he will propose a 25 basis point increase at the upcoming Fed meeting, which is next week, March 15th and 16th. Powell mentioned in this testimony that he expects the Fed's policymaking committee will approve a 25 basis point increase. And he said, and I quote, "With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. I would say we will proceed cautiously along the lines of that plan. Inflation is too high. We understand that. It will take some time, but we're going to get it under control." So obviously the Fed, everybody recognizes inflation is a significant issue. What's adding to inflation? The tight labor market. So this is the February jobs report. This is from the Bureau of Labor Statistics. Total non-farm payrolls in February rose by 678,000, and the unemployment rate edged down to 3.8%. Job growth was widespread, led by gains in leisure and hospitality, professional and business services, healthcare, and construction. So obviously, Kelly, we've got higher energy costs, we have higher food costs, we have higher raw material inputs, and we're seeing a very tight labor market. I posed this question to you before, I'm going to pose it again. Even with interest rate increases, given that we've got these supply constraints, these supply disruptions, a land war in Europe, can the Fed really get inflation under control?
They can do their part, and there's a lot going on, like Cam mentioned. I think the war, what's going on in Europe with Ukraine is a terrible situation. It's something that's really beyond our control. The dynamics around it are very complex. There's no simple solution for it. And the outcomes range from total nuclear war to some kind of resolution and everything's great. That's going to happen regardless. And what you have to think about when it comes back to our investments, okay, how does that really affect us? How does it affect corporate profits? Obviously, it's always taken into consideration. But the reality, like Cam mentioned, is the big issue that's still out there, and we've been talking about it for the last several months, is the whole inflationary picture. And we've kind of been building up to this, and now it's really starting to come to roost, where inflation, there's two components to inflation that we're really seeing both of them happen right now. You have your supply push and your supply push, demand pull. So on the supply side, we have constrained supply chains, constrained supply, that pushes up prices. The other side of it is the demand side of the equation, where there's a lot of money out there, employment's good, the economy's recovering, so you have higher demand, so that's pushing prices up. And the only thing the Fed can control is on that demand side of the equation. So we've had easy money, a lot of money supplied by whether it's the Fed or the direct governmental or congressional stimulus that was actually put in the economy. That's really created the demand side of the equation to really push up inflation from the demand side. And in the past, by the Fed increasing interest rates, that causes basically higher borrowing costs, which should pull down demand.
Suck money out of the economy.
Exactly. On the supply side, the supply chain issues, those will eventually work their way out. Companies figure out ways how to get their products more efficiently, so that will work itself out. Commodity prices will come down at some point. The labor side, that's different, as when your wages go up because of inflation or whatever reason, wages never go down.
Yeah.
I don't know anybody working for $7 an hour anymore. Once they go up, they always stay up. So there's a portion of those prices will permanently be elevated. The issue is on demand side. You throw in supply constraints because of the oil issue. We haven't really seen the agricultural side of it. Futures markets have already been bid up for wheat and corn. But they're just going into planting season, so we don't even know what that's really going to shake out to be. So elevated prices in commodities, are going to be with us for a while. So 7.9% or 7.8%? 7.8%. I didn't think we'd get to double-digit numbers. Could we see double-digit numbers in the next couple of months? It's not off the table, that's for sure. So what that does, okay, now how does that affect the stock market? Already, I really think is because of coming inflation, the market was starting to sniff it out, where different parts of the market are reacting differently. Your higher valuation stocks, your companies with a lot of leverage, with low current earnings, potential high future earnings, those are the companies that are being punished. Companies with better balance sheets, good cash flow now, growing their cash flow, growing earnings now, those companies have done all right, or more reasonably valued companies are in a better position to handle the inflation. Like I said, that was already happening kind of under the surface of the market. We had a great year last year. I kind of look at it as kind of a final run into the realities of higher interest rates, higher inflation. So we knew we were going to see more of a muted year in the stock market. The additional headline issues of the geopolitical issues have heightened that volatility. So now we're in a changing dynamic. You see a shift more back towards fundamentals. We're going to be in a world of real interest rates again at some point, a real cost to borrowing, and that's going to change the dynamic of how what's going to work in the markets. Commodities are going to continue to do well for us. We've had a position there, so now it's a matter of kind of playing the landscape we need to play. I mean, overall, is the economy fairly healthy? Absolutely. There's a lot of pros and a lot of pluses and a lot of negatives. Right now, the negatives are outweighing, and the question is, when the Fed raises interest rates, and with what we're seeing on the inflation side, is this going to be enough to push us into a recession? I mean, that's really the reality of it. And typically, in these rate hikes, ultimately, at some point, raising interest rates generally does push you into pushes you into a recession, but it doesn't come after the first 3 or 4 or 5 interest rate hikes. Right. It'll come farther down the road. So will we see a recession in 2022? At the beginning of the year, I said, no, that's not till 23, 24. Because of what's happening in Europe, cause a recession maybe this year? I guess that's back on the table. So there's a wide range of possibilities, from things working out fine, and we have a positive year in the stock market, or hey, is it going to continue to be a bad slog and we end up on the downside? It's hard to say.
It's also something we harp to continually is, unfortunately, when it comes to investing, you can't take a timeout.
Exactly.
You can't just sit on the sidelines. Good market, bad market, you've got to be in the market, because simply sitting in cash is no answer. And obviously the unintended consequence, a lot of people think, well, if I just go to cash and the market goes down, I've made money. But we've had such a big run up. Most of our positions, there are so many big embedded gains. You're going to have the tax man coming at the end of the year, and if the market's down and you have a big tax bill, you're not going to be happy about that. So we just, you got to keep plugging along. And the last thing I do want to mention is, we've said the word unprecedented so many times since the start of the pandemic in late 2019, but in all of my years of studying the market, and I've been in market cycles now for 25 years, you've been in a little bit longer, but really looking back at history, there's a lot of economists now that feel like because of inflation is so out of control, we could be looking at 7 interest rate hikes over the next 24 months.
Well, if you think about it, at only
25
basis points, that's only 7 is 1.75%. That's nothing.
Yeah.
Coming off of 1 or practically 0. Okay, we got a long ways to go. The 10-year Treasury flirting with 2%. Historically, 5% is relatively lower than average interest rate on the 10-year Treasury. So, okay, that's 3% just to get to 5% on the 10-year. Okay, that implies a lot more than 7 interest rate hikes.
Yeah.
Or will they go more aggressive than 25 basis
Doing
points?
50 basis. But that volume of increases, we haven't seen before in a market where it's not that the Fed is so behind the ball, it's just so many things have changed that they really are going to start playing catch up.
Well, prior to the issues in Europe or in Ukraine, 50 basis points was definitely on the table for this month, or there are people talking even 1%. Just take a big chunk right out of the gate and go from there, which really I believe prior to this the economy could have handled it. There have been some kicking and screaming, and there have been a little bit of pain, but that probably would have been the right thing to do. Yeah. Now they're going to pump the brakes a little bit, but they will. I think they need to continue down the path, and they will, and it could get fairly aggressive as we get throughout the year when there's some resolution on the Ukrainian front. Let's jump into the numbers a little bit, and we'll probably, I'm sure, delve back into our thoughts on what's happening. Year to date, the Dow Jones is down 6.73%. This is through the end of the month. More recently, the Dow's down over 10%. The S&P 500 year to date through the end of the month was down 8.23. NASDAQ down 12.1. Russell 2000, which is small cap stocks, down 8.78. On the international front, developed world EAFE down 6.72, kind of in line with the Dow. Emerging markets down 4.93. All those numbers are lower at this point in time.
Significantly lower.
Yeah, NASDAQ's actually down 20% at this point. Well, not counting yesterday, but we're going to see a lot of whipsaws. I mean, it's going to be back and forth for a while here. In the month of February, Dow lost 4.27%, S&P only lost 3.8%, NASDAQ down 4.14%. Russell held up pretty well, down 0.13%. International markets, developed world down 3.17%, emerging markets down 3.5%. So that's kind of what the indexes did. In this environment, kind of a risk-off environment where money's kind of flowing to dollars, that's going to be pretty challenging for the emerging markets. Obviously, international markets, especially Europe, is going to feel a lot of pain just because of the locality of what's happening there. Our portfolios for the month in February, growth with income portfolio down 0.2, so almost broke even in there. Year to date down 3.5, so holding up pretty well compared to the markets themselves. Big gainers for the month, should be no surprise. Nucor, steel producer, up 30%. Our commodity fund up 7%. Gold up 6%. Exxon up 4.4%. Big laggards, Digital Realty down 9.6%. Microchip down 9%. Nike down 7.8%. Lennar, the home builder, down 6.5%. Starbucks down 6.2%. Year to date, our big gainers are still Exxon up 29%, Nucor up 15.3%, PIMCO Commodity, which is our commodity exposure, up 15%, Berkshire Hathaway up 7.5. More recently, we have added to our Berkshire position. We actually shaved some gains from Apple, rotated into Berkshire as kind of a defensive move. Basically taking some gains from Apple, which we've had a lot of them, moved it to Berkshire Hathaway. He does hold Apple in his portfolio, but he also sits on $150 billion in cash. So you know what? I think
it's a nice war chest.
Yeah, he can take advantage. Warren Buffett will take advantage of of what's happening. Dividend yield, February down 2.3, once again performed pretty well compared to the markets. Year to date down 5.5. Big gainers there in February. UPS up 4.8, British Tobacco up 3, Coca-Cola up 2, Merck up 1.1, Prudential up 1.1. Kind of your more strong, steady, fortress balance sheets type companies doing fine, kind of like what we've been talking about. Laggards in February, Pfizer down 11, 3M down 9.6, Caterpillar down 6.9, Southern Company down 5.8. For the year, our leader, basically in this portfolio is British Tobacco down 18.26, Coke up 5, Pru up 4.5, kind of the same story. Laggards, Pfizer down 20, 3M down 15, Waste Management down 13.5. So kind of a feel what's going on in dividend yield. In price potential for the month, down 0.6. Once again, held up really well for the month. Year to date, down 5.5. A little more aggressive portfolio. Our big gainers in February, Asbury Automotive up 20.6. That's one of our newer holdings. Lithia Motors up 16.7. Obviously, in the tight car market, used car dealers do pretty well. Humana up 10.7, Stryker up 6. The laggards, this is one that's been giving us pain, and it's just a matter of how do we get out of this thing. Meta, which used to be Facebook, down 33. That was not a good move to buy that.
Zuckerberg.
But now we got to figure out how to get out of that. Black Knight down 25, Fiserv down 7.6, Comcast down 6.5. T. Rowe Price down 6.4. Year to date, the leaders, once again, Lithia Motors up 14.6. We hadn't held Asbury. I'm sure that would have been the leader for the year, but we didn't have it yet. Chubb up 5.3. FleetCor up 4.6. Boston Scientific up 4. Once again, our big laggard is Facebook down 37, Black Knight down 32, T. Rowe down 26. So some bad calls there, but we'll work through them. On the small cap front. For February, actually, our small cap portfolio gained 1.1. That was nice to see that. Year to date, still down 9.8. That was through the end of the month. That portfolio has definitely felt pain since the beginning of the month. Big gainers, Lantheus Holdings up 88% for the month. Atrion up 18.2, Triumph Bank up 14.7, CSW Industries up 8. Big laggers, Nova Measuring down 11.4. We made a lot of money in there, so that's a little bit of a give back from some big gains there. Fabrinet down 11, Kyler's International down 6, Horizon Bank down 5.9. The banks are kind of hit or miss, so it's hard to say what's going to happen there. Year to date, Lantheus still leading the pack at up 65%. Innovia up 11, Bank Financial up 3.2, Esquire up 7, and then StoneX up 21%. Big laggers, Nova giving back, Clearview down 24, and Evertech down 19. So it's going to be a choppy ride. Like Cam said, you kind of have to stay in the game because with the whipsawing, there's as many positive surprises potentially out there as there are negative. Just driving in this morning, they were talking about the economic surprise index back in September. It was very negative. It's actually, now very positive, meaning there's more potential for upside surprises than downside surprises, which once again is going to create a lot of volatility. Kind of need to stay in it, but the whole key is surviving through it. And harping back, like we always say, right now the key is we don't want to take everything to cash because once again you don't know what's going to happen, and we're invested for the long term to really get clients to where they need to be to maintain their lifestyles, to retire, do what they want to do. But the reality is having enough cash on hand, having enough safety areas or things that are working so that when you do need funds, they're available. We're not selling at losses. taking drastic action in challenging times or in dislocations, that's the surest way to destroy wealth. The key is, basically being prepared for it. And like I always say, we need to keep our seatbelts on, keep the helmets on. It's going to be a rough ride, but we're going to get through it. We've seen these situations before. This, in my mind, you have the inflationary picture that looks like the late 70s, early 80s, which everybody survived through that. Some things worked, some things didn't. And then kind of combine that with, the tech bubble or the dot-com bubble of 2000, 2001. Throw those two together, and here we have 2021, 22 is really what I see happening.
Let's not forget, we also saw a 100-year pandemic over the last 2.5 years. I mean, we were talking about in March of 2020, hundreds of millions of people being infected with COVID, countries virtually shutting down. I mean, economies going to sleep. And yet, here we are in 2022 at highs above where we were at, at the highs before the drop-off for COVID. So, I mean, we're looking at all the things we've looked at. The one thing is the global economy, the U.S. economy, is resilient. There's a lot of capital out there. There's a lot of natural inherent wealth in terms of natural resources and, gold, commodities. I mean, there's resiliency in the economy. And, things look a little bleak right now, but I guarantee we'll be sitting here in a couple of years and talking about fresh highs all over again.
I don't disagree. Like I said, it's going to be a slog through it. The economy is not that bad. Unemployment, Cam was talking about the unemployment numbers. The reality is we're now at the same number of jobs that we were pre-pandemic. So we're kind of getting to where we were before the pandemic. Some things have suppressed it, but we're still not really at an economic level to where we were in the pandemic. The market definitely got ahead of itself, and now it's really, playing the field we have in front of us, stick with individual names. That's going to be the key moving forward here. That's all we have for today. I think we ran a little long, but we appreciate you as clients and look forward to talking to you next month.
Thank you, everybody.
Thank you.